There is a truth about money that almost no one wants to hear. It is not that wealth is impossible to build. It is not that the system is rigged beyond repair. It is not even that you lack the intelligence, the talent, or the opportunity. The uncomfortable truth is this: most people will remain financially stuck for their entire lives, not because of what they do not know, but because of what they refuse to believe. The gap between the wealthy and everyone else is not primarily a gap in income. It is a gap in thinking, a gap in patience, a gap in the relationship between the mind and money. And by the time this video ends, you will understand exactly what that gap is, how it was created, and more importantly, how to close it. This is not a conversation about get-rich-quick tactics. There are none worth your time. This is a conversation about the philosophy of wealth, the slow, deliberate, almost quiet process by which a small number of people accumulate extraordinary financial independence while the majority spend their lives wondering why it never happens for them. Pay close attention, because what follows may be the most honest conversation about money you have ever encountered. Let us begin with a simple observation. Most people earn money their entire lives and end up with very little of it. They work for 40 years, trade their most productive hours for a paycheck, and arrive at retirement with barely enough to survive on. This is not an exaggeration. It is the lived reality of the majority. Why does this happen? The first reason is emotional investing. And by investing, I do not mean only the stock market. I mean the way people make all of their financial decisions through emotion rather than logic. When the market rises, people feel confident and pour money in. When the market falls, they feel fear and pull their money out. They buy high and sell low. Not because they are unintelligent, but because they are human. Emotion is the default operating system, and without deliberate reprogramming, it will govern every financial decision a person ever makes. The wealthy understand this. They have trained themselves to feel calm when others feel panic, and to feel cautious when others feel euphoric. This is not natural. It is cultivated. It is a discipline built over years of conscious practice and painful experience. The second reason most people stay poor is impatience. We live in a world designed to exploit impatience. Every advertisement, every app, every platform is engineered to make you want something now. And that culture of immediacy bleeds directly into financial behavior. People want returns immediately. They want results this month, this quarter, this year. When they do not see rapid growth, they abandon their strategy and look for something faster. And in that constant search for speed, they destroy the very thing that creates wealth. Compounding, the engine of all serious wealth, requires time above everything else. It does not reward urgency, it punishes it. The investor who stays still, who waits, who does nothing when nothing needs to be done, almost always outperforms the investor who is always moving, always adjusting, always reacting. Patience is not passive. It is one of the most active and demanding disciplines a person can develop. And most people never develop it. The third reason is the employee trap. Not employment itself, but the mindset that comes with it. When a person is employed, they are trained, often unconsciously, to exchange time for money, a fixed equation, a predictable transaction. And while there is nothing wrong with employment, the danger is in internalizing that transaction as the only available model of financial reality. The wealthy think in terms of ownership, not labor. They think about assets, things that generate income while they sleep. They think about businesses, about equity, about compounding investments that work independently of their daily effort. The employee mindset keeps a person forever tied to the next paycheck. The ownership mindset begins to build a second engine of income, then a third, then a fourth. This shift does not require quitting your job tomorrow. It requires changing the question you ask yourself each month from how much did I earn to how much do I now own that will earn for me. The fourth reason, and perhaps the most insidious, is lifestyle inflation. As income rises, spending rises in perfect lockstep and often faster. The raise goes to a better apartment. The promotion funds a new car. The bonus disappears into a vacation. And at the end of each year, despite earning more than before, a person finds themselves no closer to financial independence than they were. The wealthy are not immune to the pleasures of life, but they understand something critical. The lifestyle must be delayed long enough for the assets to accumulate. Wealth is not about deprivation. It is about sequencing. Build the asset base first. Let income grow. Then allow lifestyle to follow, funded by returns rather than depleting principal. The person who drives a modest car while their investments compound silently is making a decision that will alter the trajectory of their entire financial life. It does not look impressive from the outside. That is precisely the point. Now we arrive at the core of what the 1% already understand. There is a principle so fundamental, so quietly powerful, that most people encounter it, nod their heads, and then proceed to ignore it entirely for the rest of their lives. That principle is this: the value of any asset is not what it costs today, but what it will produce over time. This sounds simple. It is not simple to execute, because executing it requires resisting every short-term signal the world throws at you. The noise, the headlines, the opinions, the fluctuations, and holding firmly to a long-term understanding of what you own and why you own it. The investing philosophy that Warren Buffett built his entire career upon begins with this principle. He did not spend decades seeking what would rise tomorrow. He spent decades asking what would be worth substantially more in 10 years, in 20 years, in 30 years, and then he waited with extraordinary patience for the market to recognize what he already understood. He has spoken often about temperament being his greatest asset, not intelligence, not access to information. Temperament, the ability to remain calm, rational, and consistent while the world around him was driven by panic and euphoria in equal measure. This is the secret the 1% already know. The emotional management of financial decisions is worth more than any analytical edge. You can have perfect knowledge of a company's fund, fundamentals, and still lose money if fear causes you to sell at the wrong moment. Conversely, you can invest in something straightforward and conventional and generate extraordinary returns simply by never interfering with the compounding process. The market is a machine that transfers wealth from the impatient to the patient. That sentence is worth sitting with, because if you truly understand it, your entire relationship with investing changes. The first great lesson embedded in this philosophy is the lesson of intrinsic value. Every asset, every business, every stock, every piece of real estate has an intrinsic value, a true worth, not the price the market assigns on any given day, but the underlying value based on the cash it produces, the strength of its competitive position, and its ability to endure and grow over time. The market price and the intrinsic value are rarely the same. They diverge constantly. Sometimes the market prices an asset far below its true worth out of fear or misunderstanding. Sometimes it prices an asset far above its true worth out of excitement and speculation. The investor who understands intrinsic value waits for those moments of divergence. They buy what is genuinely valuable when the market has mispriced it downward, and they have the patience to wait until the market eventually corrects its error. This is not glamorous. It does not make for exciting dinner conversation. But over decades, it is the mechanism by which genuine, lasting wealth is built. Most people never develop this lens. They buy what has already risen, chasing performance, following crowds, anchoring their confidence to price movement rather than underlying value. They are not investors. They are speculators dressed in the language of investing. The difference is profound. The speculator needs the crowd to be right. The investor needs only to be patient. The second lesson is the lesson of the circle of competence. One of the quietest disciplines of serious investors is the willingness to say, I do not understand this, and therefore I will not touch it. In a world that rewards the appearance of confidence, this kind of intellectual honesty is rare and extraordinarily valuable, because every time an investor steps outside of what they genuinely understand, chasing a trend, following a recommendation, investing in something they cannot clearly explain, they introduce a risk that no amount of analysis can fully mitigate. The greatest financial mistakes are not made in areas of known risk. They are made in areas of unknown ignorance, situations where a person does not know what they do not know. Staying within your circle of competence does not mean limiting your potential. It means protecting your foundation. It means ensuring that your core wealth is built on genuine understanding, and that you never allow excitement or the fear of missing out to push you into territory where you are fundamentally operating blind. The 99% frequently invest in what is talked about most loudly. The 1% invest in what they understand most deeply. That difference compounds across decades into an almost incomprehensible divergence in outcomes. The third lesson is the lesson of the moat. In the language of serious investors, a moat is the competitive advantage that protects a business from erosion over time. It is the reason customers come back, the reason competitors cannot easily replicate what a business does. The reason margins remain strong, even as years pass, Buffett spent his career focused on moats, not out of a desire for permanent dominance for its own sake, but because he understood a fundamental truth. A great business without a moat is merely a temporarily great business, and time is not kind to temporary advantages. When you invest in a company or when you invest in yourself and your own skill set, the question to ask is always this: what protects this value over time? What makes this enduring? What will still be relevant, still be valued, still be sought after in 10 or 20 years? This question applies not only to stocks, but to careers, to education, to the skills you develop and the knowledge you accumulate. The person who builds a moat around their expertise, who becomes genuinely irreplaceable in a domain that will persist and grow, has applied the same principle to their human capital that great investors apply to their financial capital. Enduring value is built by focusing on what endures. It is a discipline of filtering, constantly asking whether what you are building will still matter when the current moment has long passed. The fourth lesson is perhaps the most psychologically demanding: the lesson of doing nothing. There are moments in every investor's life and in every person's financial journey when the most powerful action available is inaction. When the noise is loudest, when the headlines are most frightening, when the crowd is running in a single direction, the correct response is often to sit still. This is nearly impossible for most people because doing nothing feels irresponsible. It feels passive. It feels like failing to respond to important information. But here is the reality: most of the information that creates urgency in financial markets is noise. It is temporary. It is already priced in by the time it reaches most investors. Acting on it does not improve outcomes. It degrades them, because every transaction has a cost, every decision introduces the possibility of error, and every emotional reaction to short-term data pulls a long-term investor away from the strategy that time will eventually reward. The most successful investors in history have, paradoxically, been among the least active. They chose their investments carefully, understood them deeply, and then largely left them alone. They resisted the temptation to tinker, to optimize, to react to every quarterly result. They trusted their original analysis and gave time the space to do its work. Inaction, when it is the product of deliberate patience and genuine conviction rather than neglect, is one of the highest forms of investment discipline. It is also one of the rarest. The fifth lesson brings all of the others together. It is the lesson of compounding, not just of money, but of character. Most people understand compounding as a mathematical concept. Money grows returns. The process accelerates over time. They understand this intellectually and still fail to take full advantage of it because they underestimate how long it takes to become remarkable. The compound growth curve is nearly flat for years, sometimes for a decade or more. The early rewards are modest. The discipline required is significant. And most people cannot sustain the commitment through that long, unremarkable early phase. They abandon the process just before it begins to accelerate. They miss the exponential phase entirely because they lost patience during the linear phase. But here is what is less commonly understood. Character compounds the same way. Every year you practice patience, it becomes slightly easier to be patient. Every year you resist emotional decision-making, your default response to financial pressure becomes slightly more rational. Every year you live below your means and invest the difference, your tolerance for delayed gratification strengthens. The person who has practiced these disc I-plines for 10 years is not simply 10 times better at them than a beginner. They are exponentially better. Their judgment is deeper. Their calm is more reliable. Their ability to act rationally under pressure is of a completely different order. This is why the wealth gap compounds. It is not just money compounding on money. It is discipline compounding on discipline, wisdom compounding on wisdom, and patience compounding on patience. The 1% are not simply wealthier. In the domain of financial decision-making, they are operating at a fundamentally different level of psychological development, and that level is available to anyone willing to begin, to persist, and to trust the process long enough for compounding to reveal itself. Now consider a version of yourself 10 years from now, not the version that continued to react emotionally to every market swing, not the version that inflated their lifestyle the moment income rose, not the version that chased every trend and abandoned every strategy before it had time to work. Consider the version of yourself that made a different choice, Perhaps that choice begins today. This version invested consistently, modestly, and patiently. They resisted the noise. They understood what they owned and why they owned it. They expanded their circle of competence slowly and deliberately. They delayed visible consumption in favor of invisible competence pounding. They sat through the volatility of difficult years without flinching. They did not speak about their portfolio at every opportunity. They simply let it grow. At year 3, the results are modest, encouraging but modest. Life does not look dramatically different from the outside. At year 5, something begins to shift. The asset base has grown to a point where it generates meaningful income on its own. Not freedom yet, but the early, unmistakable architecture of freedom. Options are beginning to appear that simply did not exist before. At year 7, the compounding begins to speak louder. The gap between this version of you and the version that did not begin is now significant and widening, not necessarily in lifestyle, but in the underlying foundation of financial reality. At year 10, the transformation is undeniable. This version of you has built something permanent, not perfect, not without mistakes or market fluctuations or difficult years, but permanent in the sense that the habits are now deeply embedded, the asset base is substantial and growing, and the relationship with money has been fundamentally renegotiated. You are no longer trading time for survival. You are building ownership. You are watching compounding do the work that your younger self once believed only exceptional people could access. This is not a fantasy. This is the mathematical and logical reality of what happens when these principles are applied consistently over time. The question is simply whether you will begin and whether you will stay. Let us return to the title of this video one final time. Why do 99% of people stay poor? Not because they lack intelligence, not because they were born into the wrong circumstances, though circumstances do matter and genuine barriers deserve serious acknowledgement. The majority stay financially limited because of a collection of deeply held beliefs and emotional patterns that govern their behavior without their full awareness. The belief that wealth is the product of luck rather than discipline. The belief that the future is too uncertain to plan for seriously. The belief that the lessons of great investors apply only to those who are already wealthy. And the 1%, the people who build genuine, lasting financial independence, have not discovered a secret formula unavailable to others. They have simply internalized a different set of beliefs and acted on them consistently over long periods of time. They believe that value is more important than price. They believe that patience is an active discipline, not passive waiting. They believe that emotional control is the ultimate financial edge. They believe that compounding, given enough time, is the closest thing to a reliable transformation that the financial world offers. And they act accordingly. Every year, in every market condition, without exception, the gap between the two groups is not primarily a gap in opportunity. It is a gap in philosophy. And philosophy, unlike birthplace or circumstance, is something you can choose to change. The knowledge you now carry is not theoretical. It is the distilled essence of how serious wealth has been built across generations by the most respected and studied investors in history. It is available to you right now today, regardless of where you are starting from. What happens next depends entirely on what you choose to do with it. Not tomorrow, not when the market settles, not when conditions feel more favorable. Now, with whatever resources you currently have, with whatever level of knowledge you currently possess, the decision to begin imperfectly, humbly, with the full acceptance that the early years will be unremarkable, that decision is the one that changes everything. The person who begins today and stays the course for a decade will look back on this moment as a turning point. The person who understands these principles intellectually but takes no action will look back on this moment as another video they watched and forgot. The difference between those two people is not talent or circumstance. It is a single decision made now and then made again every day for the years that follow. If this conversation has shifted something in how you see money, how you see patience, how you see the relationship between time and wealth, and let that shift mean something, subscribe. Return to this content when the market gets loud and your resolve gets tested. Share it with someone who needs to hear it. More importantly, begin quietly, without fanfare, with full acceptance of how long this will take. Because the most powerful financial decision you will ever make is simply the decision to think differently and then to live accordingly. The 1% already know this. Now so do you.